Today we are going to follow the money. The market's hitting all-time highs, but that doesn't mean everything is winning. So we're going to break down the last 3 weeks of action and find out where the smart money is really flowing and where it's not. Let's dive in.
So let me ask you something. The major indices, they're hitting all-time highs, but is your portfolio keeping up with that? If you feel like some of your trades are lagging, well, the answer might be simpler than you think. It really is all about where your money is positioned. And this quote just nails the current market mood. I mean, despite all the noise, a potential government shutdown, you name it, the market is just in this powerful secular bull run. It's got its head down and it's just pushing higher, totally ignoring the headlines.
So where's the actual proof of all this bullishness? Let's look at the real data from the last 3 weeks, starting right after the Fed's latest rate cut, and see what's really going on under the hood.
Okay, check this out. This slide really shows the market's internal strength. The S&P 500 is up a solid 2.3%. But look at the real leaders here. The tech-heavy NASDAQ 100 and the small-cap Russell 2000 both are up over 3%. What that tells us is that money is flowing into growth. And that, my friends, is a very, very healthy sign for the market.
So the indices are strong, but a rising tide is definitely not lifting all boats. When you drill down to the sector level, there is a massive divide happening right under the surface. Let's take a look at what I'm talking about. And this is where it gets really, really interesting. The #1 performing sector over the last 3 weeks, you're not going to believe it. Utilities, up a staggering 8%. That's the defensive sector leading the charge. And right behind it, you have the aggressive tech sector and another defensive player, healthcare. This is a fascinating, kind of weird mix of risk-on and risk-off leadership. Now, here's the other side of that coin. Look at this. The two consumer-focused sectors, staples and discretionary, along with communication services, are all down over 2%. So money isn't just moving into the winners, it's actively rotating out of these specific areas. It's a huge tell. So what's the big takeaway here? Well, we are seeing a very specific flow of capital. It's moving out of consumer areas and pouring into two very different places: defensive utilities and aggressive technology. This is that great divide you absolutely have to understand to trade this market right now.
Okay, technology is a clear winner. We've established that. So let's crack it open and look inside the sector. Because not all tech is created equal, right? And finding the leaders within the leading group, well, that's what separates the good traders from the great ones.
I mean, wow, this chart tells the entire story. Semiconductors are absolutely on fire, up over 10% in just 3 weeks. Computer hardware is also a huge winner, up over 8%. But then you look over its software, and it's barely moving. The real momentum, the real juice, is clearly concentrated in the hardware and the chip space. And this all comes down to what traders call relative strength. Basically, what's outperforming the market. Your goal is super simple. You want to be in the strongest industry group inside the strongest sector. That is how you find those explosive moves. All right, now, even in a strong bull market like this, you have to be smart about risk. Trying to short the top is just a losing game, believe me. So instead, let's talk about how to use the warning signs to manage your risk and, more importantly, stay in the game. Here are 4 really practical ways to manage your risk. First, ease up on that margin. Seriously. Second, think about using broad ETFs to diversify away from any single stock blowups. Third, maybe scale back on any of those highly leveraged products. And finally, if you've got some big gains, consider using covered calls. That's selling options against your stock to bring in some income and protect those profits. These are simple steps, but man, they can make a huge difference. And here is a perfect example of one of those warning signs. Last Tuesday, we saw this classic bearish rotation. Aggressive consumer stocks were sold off all day, while defensive staple stocks were bought up all day. Now here's the crazy part. This signal actually reversed the very next day. But it's a perfect example of the kind of subtle shift you need to be watching for. All right, so we've gone from the big picture all the way down to the nitty-gritty. Now let's put it all together and see how this kind of analysis helps us find specific stocks that are poised for some really big moves. Let's look at this classic setup in Netflix. First, you get the signal, a false breakdown on really high volume. That's a clear sign of big institutions accumulating shares. Second, the context. This happened just 2 weeks before earnings, which is a prime time for the big players to get positioned. And finally, the confirmation.
The accumulation/distribution line was already hitting new highs, showing there was some serious buying pressure under the surface. This is a repeatable pattern you can look for over and over. So what's the payoff for doing this kind of analysis? How about a 25% gain in just 3 days on a stock like IonQ, which is in that red-hot computer hardware group we talked about? This is the power of finding the leading stocks in the leading industry groups. It can absolutely supercharge your portfolio.
So we've followed the money, from the broad market to the sectors to the industry groups, all the way down to a single stock. The data is clear. The only question left is this: how are you going to position your portfolio to ride this wave?